Boris Sanchez of Sanmore Investments is going to present what I think is a really interesting topic, which is how you build a real estate empire without going through all this hassle of syndicating deals. Boris has built himself quite a substantial portfolio just through other strategies, which he's going to discuss here. So Boris, why don't you start off by introducing yourself and give us a bit about your background, and then let's get into it.
Thank you very much, Jonathan. I appreciate the invite too. I gotta say thank you to all the previous presenters. Thank you to Ted. It's great and refreshing to hear somebody that's done the research rather than just get wrapped up in the politics of politics. So it just kind of goes back to, I was listening to him and all the research he did, and I realized how important it is to do your own research rather than just believe the talking mouths out there, the fake news. I know that there was a lot of news talking about 1031 exchange going away because of Biden, and that got shared a lot on social media. So I'm glad he clarified that. Thank you to him. I do have a presentation, Jonathan. So do I?
Yeah, well, actually, before we get into it, just tell people about your own background a bit, and then we'll jump into it.
Sure, no problem. So I am 36 years old, for the folks that are wondering. I have 10 years of experience in the corporate world. I got myself an MBA from out of London, and then after that I got another 10 years in real estate thus far. I started off in the mortgage world, so I'm really kind of knowledgeable with the residential and commercial mortgage programs that are out there. I started investing in multifamily myself around 2013, 2014 is where I started the company, Sanmore Investments, and we're to this day going strong.
Very good. So let's jump into your presentation. Then you have the power to share your screen.
Yeah.
So just go for it.
So share screen. All right. Can everybody see that?
Yes.
Excellent. All right. So, okay. My presentation is on active multifamily investments as opposed to, for example, passive or syndication, which is obviously, I know a lot of folks in your community they like to syndicate and they want to find out more about syndication. You have an entire program around it, but I just kind of want to change or challenge a little bit of the thinking around. Look, the only way to grow is syndication. It's not really, as I've kind of proven it, and obviously it's not just me, but a couple of people have proven it, that they just go in and amass a certain amount of units. So I'll get into that. So at first, let me see, how can I, okay, here we go. All right. So just want to, first of all, just ask the audience some questions, just food for thought, Why do you want to syndicate? Is it wealth generation? Is it experience? Why do you want to do that? Second, what is the point of owning the most amount of units possible? Is it because you think that the more units are going to get you the most amount of wealth, which is, a general thought out there? That may not always be true, right? If you have paid off property, if you have 4 units, it's probably sometimes better than having 10 units with leverage, right? So it just kind of depends. Just want people to kind of think about that through the presentation. Why, if you do syndicate, why would you want to expose yourself to other entities such as the SEC, the partners, strangers, stuff like that? There's a lot of reporting in syndication. There's a lot of prying eyes, and are you truly ready for that? Is making money for friends and strangers a priority over your own wealth creation and maintenance? Is it? I mean, do you think it's, I know it's fun. I've done, a couple partnerships, and it is fun when you, at the end of the day, you sell that deal and you make your friends money, or your folks that invested in you and trusted you with their funds money. But is that the best way? Is that the best way to create, wealth for yourself? So here we go. Who is Sanmore Investments? Thank you, Jonathan, for kind of introducing me there and allowing me to introduce myself. We started in 2014. Now we have over $30 million in revenue. We've owned over 800 units. 512 units are owned by us, by myself, 100%. We also have a parallel brokerage company. And so what we do in Sanmore Realty and Sanmore Investments as a broker is we kind of package deals together. So what does that mean? That means that we actually take the programs that we know, such as hard money, which I will talk about in depth, and we match it with a deal. So for example, so some of you all have seen my blast out there, our company's blast, where we say, hey, come to this deal. It's 8-unit deal, 15-unit deal with $15,000, $25,000 out of pocket. What does that mean? A lot of people say, hey, that's not the true price. You're saying that complex is $15,000. No, that's not what I'm saying. It just means that that's the introduction to what we do. Let us educate you. And why are you just going to bring $15,000 to closing, $25,000, $30,000 to closing for these smaller apartment complexes, which you can handle yourself. So I will explain that more in detail as we go on. So we in Sanmore, we have done it all. We have done flips in multifamily. We have done short-term holds and long-term holds. So I'm going to kind of explain and give you some examples over what the stuff that we have done and our experience thus far in using these kind of products and actually dealing with these kind of assets. So our first ever deal, let me tell you about that one. That was a pretty good one of my favorites. It's a 8-unit complex in the east end of Houston. It was all 1 bed, 1 bath. We purchased it at $140,000. The loan was $200,000, which included $60,000 in repairs. So we used hard money on this deal, which for the folks that don't know what hard money is, I'll get into that in a second, but hard money, basically, it just kind of gives you the amount of purchase plus rehab. So it gives you both purchase and rehab so you can come to closing with 0 down and very little closing costs. No down payment used on this deal. All I came to closing with was $10,000, okay? So this is, again, an 8-unit complex in east of Houston. 14 months later, as you can tell in the picture, it's completely renovated. We leased each one for $750 each. There's no HOA, no utilities, minimum maintenance because everything was kind of brand new, plumbing, electrical, everything. We made $33,000 net on rents. And then, we put it on the market. We sold it, and it sold for $450,000, which is about $253,000 in net profit. Now, this is my very first deal. But as you can imagine, I decided, you know what, I want to do this for the rest of my life in some way. Obviously, I didn't have to do a lot of on management or on-site construction or anything like that. Believe me, I wasn't out there hammering nails, but I did obviously get a good contractor that helped me renovate these units. So what is hard money? So hard money is a type of loan where it's kind of different than your normal loan. So your normal loan is they're going to check on credit, they're going to check on DSCR, they're going to check on everything like that. All you guys are very familiar with. This one is more like a pawn shop of real estate. They give you money based on the asset itself and what it could be worth in the future. So in the future, as long as a property's total cost doesn't exceed 70% of the future value, you can cover up to 100% of the cost. Now, is that normal all along hard money lenders? No, it's not. Sometimes some of them will do 90% loan to cost. Some of them will do 80% of cost, especially nowadays. But they are out there. We are one of them, one of our lenders that do 100% of cost, as long as, again, doesn't supersede 70% of the ARV, which is actually very doable in multifamily as opposed to residential, where we have seen a lot of competition. And now, I don't have to tell you guys, you probably have been looking at these prices for real estate, for residential real estate. They're at 80, 90% of cost from the ARV. So it's definitely not worth it. It's easier in multifamily, in small multifamily. So again, obviously, why hard money? Then I just kind of explained it, because you can cover 100% of the cost. Now, I do have to say, yes, it is a more expensive loan. It starts around 11, 12, 13%, depending on your state. But it's a way, again, to bring in the least amount of money possible to a deal, raise the equity, force appreciation, and then refinance if that's what your goal is. Most of the time, you are going to want to refinance because, especially in this market, we don't know if the asset, will be sold right after you finish rehabbing it and filling it up. So what I will always recommend is, hey, look at the refi option always, which means that you kind of have to know kind of programs that are out there right away before you even look at the deal, right? You have to kind of know how you qualify, what kind of reserves you'll need, both for the hard money side and for the refinance side. So obviously, very, very much a fanatic of learning financial products, but before you actually get started. I'm a huge fan of education. Everybody always asks me, hey, how do you start on this? How do you start on that? Well, like I always say, education is best. There's nothing like education. Read. Make sure you get with folks like Jonathan, folks like myself, that can guide you in the process as well. Just because you're an active investor doesn't mean you have to do it by yourself. That's not what I'm saying. There's a fine line between doing it all yourself with no education and actually being guided by somebody that knows what they're doing. So let me get into some more examples of the stuff that we have done in the past. This one is also in Houston. It's a 7-unit complex out in the 5th ward of Houston. Purchased at $140,000. We put about $200,000 into it. Again, we got 100% loan from our hard money lender, and we sold it for $507,000 2 months later, and with 1 week on the market. At that point, we made a record per unit sale for that area of town. That's very much a C-class neighborhood. So profit was at about $167,000, and I actually had a partner on that one. We ended up splitting it down the middle. So very nice deal. The loan amount was $340,000, and again, we brought 0 down. There's another 8-unit complex out of Magnolia, out of the east side of Houston as well. We purchased that one at $185,000. We put about $150,000 in. We got a little creative with this deal. I'm always, again, also a fanatic of being creative in a deal, and I will you'll get into that a little later. And when I show you a deal, our latest big deal that I just bought and what we did there. But on these, the living rooms were so enormous that we ended up putting in a 2-bedroom instead of a 1-bedroom. Obviously, 2 bedrooms rent for more than 1 bedrooms. So we always want to make sure we look out for that. We sold it for $545,000 2 months later with only 1 month in the market. Very, very nice product. So what we do always is make sure we don't price it at the very, very top of the market, but also like it is famous and popular in this industry, make sure you leave a little bit of meat on the bone, especially right now during COVID times. You're going to want to put more meat on the bone or leave more meat on the bone in order to have a successful sale. The next guy also wants to make money from your deal, so you kind of have to know that up front. We made a profit of around $210,000 on this deal. The loan amount was $335,000 and 0 down again.
Hey, Boris, I just want to interrupt and just say, I love this kind of thing because this is like real true value add, right? Where you bought this thing priced for 1 bedrooms and you turned it into 2 bedrooms. I mean, that's the kind of creative thing.
Oh, you're going to love what I have to say in a little bit.
Yeah.
Thank you, Jonathan. Yeah, it's true. Creativeness is the part of our culture, and it's what we ingrain into all our students and clients, people that want to work with us. Creativeness all day long. Just because it's a 4-unit complex doesn't mean it has to stay a 4-unit complex. Now, make sure you're not violating any zoning or deed restrictions or city codes, right? But within the constraints of the law, make sure that you are being creative and maximizing every penny that you can out of the place. What we do sometimes, a lot of the times, is we I think I've told you, Jonathan, in the past, I'm not a fan of CSC. I don't know why anybody would be. It's an evil corporation, if you ask me. Buy your own machines. Buy your own machines. Tell you what, in one of our complexes, we have 3 machines.
Laundry machines.
Laundry machines, yeah. Laundry and 3 dryers. We make $1,000 out of the place. And around the neighborhood, it's a 7% cap. So yeah, we make $1,000 a month, but you know, it's not a big deal. But if you were to apply that like an NOI, it would mean an additional $171,000 at a 7 cap for that complex. You know, so it's not so much about out of sight, out of mind. If I don't have to deal with laundry, then that's fine. It's just another amenity. No. Be creative. Make sure you put in your own machines and make sure your maintenance can fix them. Right. That's a big one. So anyway, let me keep on going for the short-term holds. So short-term holds, we will typically refinance with conventional bank financing. Even now, believe it or not, banks are still lending on multifamily. We're lending down here. Have they dried up? No, they haven't yet. They are a little pickier on what they do, but it's still available. So most banks right now will do 70 to 75% loan to value, which means 25 to 30% down if you so want to purchase that way. Make sure you're also looking at your reserves that you need extra, your interest reserves, because that will come into play. Right now there's between 3 and 4.5% interest rates. Most likely it's going to be a 20-year amortization with a 5-year term, and about 1 point of origination is what we see for kind of like banks doing out there. Now, credit unions, they will do something better. Sometimes we'll do 30-year amortization, straight fixed. We do know of a couple of credit unions that will do that. Banks and conventional financing are best for refinance under $1 million. So for for those folks that don't quite reach the Freddie Mac and Fannie Mae levels, definitely look into a credit union or a bank that can help you. All right, which is what we have done, especially on these deals that I'm about to show you next. So this one is a 15-unit deal out in Cloverleaf, Texas. It was purchased at $285,000. We put in about $250,000, and then we sold it at $885,000 after 3 years of hold. Now, some folks may call that a long-term hold. I call that a short-term hold because it's obviously you're kind of making money on the place, and you want to maximize your income before letting somebody else have it, right? And then moving on to the next best thing. The rent income was $150,000, and the profit was over $500,000. Right? So this is a deal that I went to about once a week. I had my contractors out there. I had my manager out there. So for those folks that are wondering, yeah, great, I don't have a lot of time. You don't need a lot of time. You actually don't. It's all about your team. Set it up first. Make sure you're setting it up from the get-go with really good people, very, very well-paid people, and they will help you. The loan on this one initially was $535,000 and 0 down with hard money. I believe we only came with $20,000 to the table on this deal. So very good. I do have to say, to tie it in with what I was saying last, is that we did refinance. Obviously, we didn't keep it for 3 years in hard money. That would be very, very expensive. We refinanced, I believe, 7 months into owning it after it had been rehabbed. So we refinanced into a conventional loan with 20-year amortization. So for larger multifamily financing programs, we have the ones that obviously this is for $1 million or more kind of loan amounts. Right now, Freddie Mac and Fannie Mae are for Houston doing 75% LTV. I believe for some reasons, Houston is looked at as a secondary market. For primary markets, I believe they're still doing 80% loan to value, but they're still doing 30-year amortizations, 10-year fixed, and 1, 2, or 3 years of interest only. That's very nice in order to stabilize a bigger property. Of course, for you folks that want to partner up with other people, I didn't say syndicate, I said partner up. If you want to partner up with your friends or buddies, That's perfectly okay. A lot of the times your reserves, your cash in your bank account will be cumulative. So it's completely counted, counted in on the big pool. And it's non-recourse. That means that you won't be personally liable with your own assets. There's also HUD, which is worth it for properties that are $5 million and over, and as well as CMBS, which is kind of less popular now after COVID. But last I heard from my friends at Arbor, they are still lending. So very good to think about if you have a larger property with $1 million more of loan amount. So let me tell you about the long-term holds that we have had. This is a 44 unit complex that actually we ended up adding to because we went around buying the homes around this complex. And we actually expanded the parking lots. We ended up with 46 units in the end. But we purchased it at 1.75 million in August of 17. Put in about $600,000 of the bank's money, and the rent income will be around $300,000 per year. We had done a cash out of $800,000 in July of 2018. And right now, fast forward to 2020, it's under contract for $3.5 million, marking an additional $800,000 in profit. So this one's kind of a longer term hold. Why? Because this one was refinanced into a Freddie Mac loan. We had some really good terms, but unfortunately we had some really good terms for the time pre-COVID, which was a 4.97 interest rate, kind of high for now. But yeah, so we just kind of decided that the next best thing would be to sell this property and capture that additional profit.
So Boris, you did this one. You bought it with a hard money loan, and how much did you put down on this?
Very good question. We actually bought this one as a bank loan, and actually, I forgot to say this deal right here was actually put in 1031 exchange. The profit for this one was put into 1031 exchange to help you buy this one, the one I just showed you. So I didn't really come up with anything out of pocket. It was just the profit from that other deal. So 8 unit, for those keeping count, for those 8 units gave me the money to buy a 44 unit or 46 unit now. So, it was a very good deal. Very good deal from the start. Am I going to 1031 this? I'm not sure yet. So it was actually interesting what Ted had to say about it. So I'm kind of relieved now that that doesn't seem to be in the cards anymore, getting rid of the 1031 exchange. This is the largest deal that we have bought to date, and it is a 100 unit complex that didn't start out that way. It actually started out as a 72 unit complex purchased this March, right before COVID happened, for $3.4 million. Okay, so what we did is we actually ended up splitting the units into 2. So we have very large 1 bedrooms, the type that you walk into the huge living room and you go around to the huge bedroom. Instead of having one bedroom at $400, $450, we actually ended up modernizing and splitting the units, so to make a studio out of the living room and a studio out of the bedroom. Hence having 2 more units instead of 1. Those units have been rented at around $650 a piece. So again, combine both deals and it's $1,300. As opposed to $400 where it was renting at before. So it's a very, very nice value add deal. It's been ARV valued at $8.5 million as a 100 unit complex. We ended up only bringing $40,000 to closing. So what I did on this deal, I did buy hard money, but I made a special deal with the hard money lender saying, let me defer some points to the exit. Is that available to everyone? Probably not right away, but if you build a relationship with your hard money lender, then for sure they will they will let you have that. If not, I'm sure you can find another one who will. The potential cash out of this one after what we owe is about $1.5 million. I do want to point out that that cash out is tax-free. It's tax-free for me. I can literally go and spend it at Disney World if I want to. Obviously, that wouldn't make the most financial sense, but that is a very good start. I'm able to keep the cash flow on the property. I'm able to keep the asset itself 100% and keep the cash flow, you know? So that one's gonna be a very good deal. It doesn't make any sense to sell it. Obviously, I've already taken all my money out and it's producing some very good money for me. So in addition to being a depreciating asset according to the tax code, and you know, give me a big break on taxes every year. So folks ask me all the time, okay, that's all great, but what about residential? Oh, I had a question about this not too long ago. And do you recommend starting out at residential? Do you recommend buying residential and multifamily? I do, as long as it makes sense. I used to be always against just buying residential as is. Why? What for? There's no forced appreciation in a home. But it does make sense right now to diversify your portfolio as long as you are still maintaining that management and maintenance, and you can combine it with your multifamily to make the most amount of sense. So if you have, have a 4-plex, 8-plex, 9-plex, and then you also have a few homes near there, then it kind of just all makes sense to have the management and maintenance be together in the same place to kind of form some economies of scale, right? So they are very, very high in demand during COVID period. I would say almost in Houston, at least, they surpassed the demand of apartments. So obviously you kind of have to think about that. Like I said, if it makes sense, yes, buy residential alongside your multifamily. Just remember that your $100,000 home or $200,000 home, even if rented at $10,000 a month, it's still going to be $100,000 to $200,000 home. It doesn't change. It has no forced appreciation. You're purely buying it for cash flow reasons, so kind of remember that. So why become an active investor or full owner? Obviously, first and foremost, profit. I kind of talked about profit. You guys see me be profitable in these deals. I'm 100% the decision maker. I don't have any split decision. To my knowledge, I don't think there's a way to split the 1031 monies. It's either all or nothing, from what I understand. You are able to fully use the 1031 before it goes away, right, at one point. And a very, very good tool to use when you are just the sole owner. There's no reporting to any partners or the SEC. You know, there's no cash calls other than yourself. There's no embarrassing, hey, we're gonna need to hold off and giving you guys money for this quarter because we don't know what's gonna happen next. There's none of that. You're the full owner, so full decision maker. Depreciation and tax savings. I talked about that a little bit. The depreciation is amazing. It's an amazing tool. I know that Ted and Jonathan talked a little bit about having the bonus depreciation go away. So until it does, I mean, it's great and a great tool to use for your active investment assets. You are a single member entity, so the whole tax reporting is kind of streamlined, and there's no, unless you have a corporation, there's no K1s issued. It just all falls under you. There's no bosses, just the lenders. You know, there's nobody breathing down your neck talking about let me see this month's quarter, or let me see this quarterly report, or the month's earnings, or anything like that. Just your lender. Most of the time, hard money lenders or banks won't ask you for any reporting. Now, Freddie Mac and Fannie Mae will. They just kind of want to see you maintain the SER. So obviously, just look out for that. That's minimum reporting. All you have to do is just get them an NOI for the quarter or anything like that. Just putting that information. Tax-free profit with refi cash out. Yes, I talked about that, especially in the last big deal that we just bought in March. You are able to cash out with refinance. Obviously, you can do that with syndication with partners, but obviously you are the decision maker and it's all your cash, right? You can use it however you want, and no need to have reserves held back. Also, obviously, what if the worst happens? If the worst happens, it'll just be you. If, let's say, everything goes to hell in the handbasket, then, fine. You don't have to kind of hide your tail between your legs because you couldn't perform to your investors, to your international people, to all those folks that believed in you. Hey, if the worst happens, it'll just look at you. And you can, most of the time, make deals with lenders to help you keep it or help you make a modification on the loan or anything like that. Most times the lenders want to see just you paying the bill, so they will work with you to get that done. All right. So this all sounds great, Boris. How should I start? Well, make sure that you understand your financing products and your risk. There are different risks for everything. There's risk to syndication. There's risk to being an active investor. Make sure you understand that. Make sure you understand your ways out, your entry, your exit strategy. Make sure you have plenty of cash on hand. Obviously, it's just like any other asset. You want to make sure you're liquid as well. Make sure you meet the requirements, right? Your cash reserve, your team, your experience. As much as I would say, hey, I'll sell you a 100-unit complex to a beginner, it just doesn't work that way. Most of the time, they won't lend it to you. But so make sure you understand and strategize. Have the right amount of cash reserves. Have your right team, your managers, your contractors, and make sure you have the knowledge and know-how how to proceed. So identify opportunities. Obviously, in this market, in my mind, we're going to see a buyer's market come through. So it's going to be very easy or sometimes even deceiving to look at properties and know for a fact that they are opportunities. I get calls from my peers all the time saying, hey, this 58 unit in Killeen, Texas, this sounds like a great deal. It's $32,000 a unit. Hey, Killeen just, is getting a really bad rap because of Fort Hood and everything going over there. There's could be talks of shutting it down. Killeen is an army base. It's very much a secondary and tertiary market. So just because they have it has a low price doesn't mean it's a good deal. Just like Jonathan said with the previous panelist, you have to know what a good deal is, and a good deal has to be a good deal. And even the best deal can become bad, really quickly in the wrong hands. So just make sure you're identifying the right opportunities and you're being patient. Consider the right strategy, right? Either you're flipping, you're short-term holding, or you're long-term holding. You might have to refinance more than once. That's perfectly fine. I learned my lesson. I had a 32-unit complex that I bought in February of 2018 that I thought I was just going to go straight from hard money all the way to agency with Freddie Mac. Then COVID happened and everything was put on hold. I got stuck paying hard money rates, 12% on $1.5 million starts to hurt after a while. It's like $15,000, $17,000 a month. So the property, even though it was nice and beautiful, it didn't cash flow to cover that much mortgage. So I just kind of had to hang in there. So if you have a clear strategy and you can kind of anticipate the worst, make sure you're doing that and make sure you're keeping tabs on the early termination penalties that banks may have. Make sure that you're identifying things like what's yield maintenance or or any of those early termination structures out there. In order to identify the proper strategy. Be creative. What is your goal? I talked about being creative. We started, like I said, in that one complex. All we had to do is add a couple sub-meters, add some parking, and split those units down the middle. People love them too. One time we got 40 calls during a day for those studios, and people, even bankers come up to me all the time saying, "What are you doing out there now? And you're splitting units? I didn't even think that was possible." Yeah, it is. You know, you just got to be a little creative. Didn't have to build from the ground up. It actually cost me $10,000 to split one unit. So very little, and that's how much about people will spend on just renovating one unit, let alone renovating two. So very important to identify the right contractor, and identify also along how much time do you have in a day. A lot of folks are saying, yeah, great, this all sounds beautiful, but yeah, I'm a corporate kind of guy. I don't have a lot of time. That's fine. I have plenty of clients that are corporate. You know, they have regular 9-to-5 jobs, and they still are active investors, full-time investors, because they chose the right team, because they chose the right contractor. And I'll give you guys a tip on contractors. Make sure that your contractor works on site all the time. The actual guy that you contract, make sure he works on your property at all times. Why? Because I've tried them all, trust me. And one thing is consistent is if the guy that you are going to hire is on site at all times, he's fully responsible, he knows everything going on. I've had it where the guy I contract never even went once to the property. So he didn't know what was going on. So I had to, you know, just kind of scramble around and look at who did stay there the whole time that can answer some questions. That wasn't a positive experience. So yeah, so the right team can make or break you for sure. Management, obviously there's self-management. Right now, nowadays, it's just becoming way better to get payments via Venmo, Cash App, Zelle, all those different ways that you can get payments. There's Rent Cafe for those Yardi users, and other, you know, softwares out there like that are very easy to handle management or receiving money. Rent Cafe is one of the ones that lets you even lets a tenant put in their own maintenance request online, so that a lot of the times you don't really have to hire a third party to, or even an employee to manage it. It's becoming easier and easier, and obviously the better shape that the property is in, the better plumbing, the better electrical system, the less maintenance you're gonna need. So make sure you look out for that. I know that me and Jonathan kind of differ at this point, but once you start having enough units, do you recommend getting a third-party management? I don't. I actually recommend you just hiring your own people, because, I know the way that I want these properties ran. I want it to remain lean. I don't want to manage the manager or manage the asset manager that manages the manager. And it's just too much. In a lot of ways, a third-party management company is conflict of interest, because after all, they're making money from you, not from anybody else. So, you know, what's preventing them from doing that, nickel and diming you? That never really sounded really good to me. So what I do is I just hire my own people. They get paid $13, $14 an hour. It's not terrible, but it's not terribly high either. And so, yeah, I trained them, and now we're up to 22 employees actually in Sanmore Investments. So done pretty well the last few years. Where to find deals? Okay, yeah, there's a lot of places to find deals actually, not just brokers. You know, a lot of people will say, well, wait for a broker, and the broker will just come down and maybe he'll bless you with a good deal. That's not really true. So for obviously, first and foremost, we are brokerage, as I mentioned. Sanmore.com is a website where you can go and actually look at any Houston available deals. We're still working on other markets and expanding, but for now, if you're interested in Houston, look at sanmore.com and click on offerings to see some of the deals. Facebook groups is becoming a very large place to actually get deals. Some of the ones that I mentioned, that I can mention, is Jonathan's multifamily deal makers community. Some people do post deals on there. They'll post services on there, so very good. And my own apartment investors network. It's a community of over 13,000 people, investors. We actually promote all of services. We have deals, we have lenders, we have the discussion, we have education. So make sure you check that out and join Apartment Investors Network. And Jonathan's multifamily deal maker community. And what's the other one, Jonathan?
Multifamily investment community.
Multifamily investment community, correct. a very, very good one for discussion as well. Obviously brokers, realtors, wholesalers, and word of mouth, that, obviously is always out there. Make sure that you're not just relying on brokers. And if you are just relying on brokers, make sure they know exactly what you're looking for, that they have your proof of funds ready to go, and you have your clear strategy ready to go as well. The MLS, scrubbing the MLS list is a very nice one. Offering wholesale rates to people that have old MLS listings or expired listings. That's always a good strategy. And one of my favorite things to talk about is driving for dollars. That seems to be a very beginner thing to do, and people, some people would kind of like cringe at that, driving for dollars, but really it's a very useful tool. I've bought a few deals just from driving around and looking at, beat up deals, writing the address down and then doing some skip tracing. It's, a very, very useful tool, and you'd be surprised. Some deals fall through the cracks of everyone, and you're the first one there. So very, very good tip as well.
Yep. I'm going to add something here too, which is someone once gave me this tip a long time ago, talking to brokers about deals that never closed, like deals that were never able to sell, maybe 6 months ago, a year ago, 2 years ago, because sometimes they never did sell, and now the seller is realistic. So that's a good point.
Exactly. Yeah. So that's kind of like terminated or withdrawn deals, or deals that just like I said, just never sold. Brokers will just kind of let it go and go on to the new thing. So and most of those sellers are, that the seed of selling has already fully grown into a very big tree that he wants to sell, and so make sure you're scrubbing for that. Last thing, I do want to kind of throw my name out there as a guru or as a educator. I do have a personal consulting kind of business. If you think you might need personal training, I have a program. It's $7,000 for a 7-week program. We meet once a week for about an hour and a half to 2 hours every time, and we go over everything, strategy, analysis, our own deals. We kind of we'll show you what worked, what didn't work, go over all the strategies, all the lending, more in depth. So if you need that, please ask. Feel free. All right, and with that, I think that is it. I will take, if there are some questions, I'd love to answer them.
Yeah, well, first of all, thank you very much for that, Boris. That was really terrific, and I learned a lot. It whets my appetite to go out and do deals by myself, to be honest with you.
Sure.
So I did have a few questions, and there's at least one question so far, and you guys should feel free to pop questions into the Q&A box. But one question I had was, how do you calculate the ARV on these properties? Like, I know that your lending is actually as a percentage of ARV, not as a percentage of the value now, which is different from kind of traditional bank lending if you're doing hard money. So how are you calculating the ARV?
It's still through an appraiser. So, I mean, obviously at first we will look at it. We will look at the market. We will draw some comparables, look at what the cap rate was that those deals have sold for. And so we'll go into it with an estimate. We will submit the deal to a hard money lender with an estimate of what we think it'll appraise at, and then we will, once the hard money lender approves it, then we will go on to the appraisal phase.
So is the appraisal one of your out-of-pocket costs for the deal?
It would be the borrower's. Yeah. So yes, it would be my own cost.
And what have you had a situation where it didn't appraise, the ARV didn't come through where you expected it to?
Absolutely, especially during the start of all this, during March, April, and May, we were still buying deals and selling deals, but some appraisers just, it's worth half because of COVID. Well, what does that mean? Aren't people paying rent? Well, sure, but it's worth half, so now it's at a 10% cap rate instead of 7%. Well, no, that doesn't really work that way. Obviously, the way we market and we appraise a property on this in this country is, we will take into consideration some conditions of the market, but most likely we will just break it down to its basics. What is it? Is it actually paying? Are the tenants actually paying in the area? What are the rate that they're paying at and all that? So, so we had some instances where the appraiser just wanted to be too aggressive or too conservative on the actually ARV. But a lot of the times we're able to argue that and prove them wrong, or even just move it to another appraiser.
And so in that case, you have to just eat the cost of that appraisal. Is that just?
Yeah. I mean, there is no application fee for hard money lending. There's just upfront costs. You know, again, like I said, we will do our best to try and estimate what the ARV would be. We're very knowledgeable in the Houston market. We've looked at Florida, we've looked at Georgia, a lot of red states we have looked at. Because you know, what we find is you know, common. There's a certain cap rate, and there's a certain type of rent that people will pay, and there's a certain type that people will not. So we break it down to the basics, and we analyze the area before coming to the conclusion that we should get an appraisal.
Then what about hard money loans in the kind of larger multifamily context? As if you're looking at a bigger deal, are you able to get hard money, or is there something similar to it, like construction loans or something else where you put very little money down, you're basically borrowing pretty much everything? What's the lending environment like for those larger deals?
So for the larger deals, yeah, the hard money is available for larger deals, $1 million plus. I just did that one for the 72 unit that I bought in March. That was 3.6 million, but I structured it different. I kind of told the hard money lender to let me pay some points at exit, just because I knew there was so much equity to be raised, and I mean from the forced appreciation side, that it was going to make sense. It was going to make sense even if I were to pay the points at exit. We came to closing with $40,000. How many folks do you know that come to closing with $40,000 for actually it was a $4.4 million loan? Not a lot. So definitely that was done after we had kind of cemented a relationship with the hard money lender. As I said, if your group is looking to hard money or to borrow at hard money for your large projects, absolutely. I know some lenders that will do it. I know some lenders that will do 90% of cost. And some of them will even roll in like 6 months interest. So yeah, there's a lot of creative financing out there. And you kind of just have to find them, do your research, and get to the bottom of that. I will have to say that any kind of bridge loan or any kind of hard money loan is a tool that has to be used as a tool, not for long-term financing in any way. It comes down to time, it's a race against the clock to get the property rehabbed and fully stabilized, or at least full of tenants, so that you can refinance. Otherwise you'll be stuck paying high interest rates.
Does this work if you are buying a property that is already fully tenanted? You're going to reposition it, but as opposed to, because that kind of may slow down your rehab if you have tenants on site. Do you really focus on vacant properties or properties with really low occupancy? Is there any kind of threshold above which this doesn't work?
Yes, there is. I mean, I've bought deals that were full of tenants, but it was a negative cap rate. Just because it's full of tenants doesn't mean that they're paying, or doesn't mean that they're paying anywhere near market rates. So for that, obviously, a lot of the times for rehab deals, you're going to have month-to-month leases, or even when you have leases. I know of a deal right now in Houston that's a 96-unit deal, and the owner has never had any actual leases. He just allows people to pay their deposit, and all right, just pay me rent every month. That's fine, but it kind of defeats the purpose of what you're doing, especially as a rehabber, as an active investor. You kind of have to get those leases. You kind of have to make sure that you're raising the equity from the forced appreciation side to make it worthwhile for the cash out or for the refinance, right? Your end goal at first should not be to profit. Your end goal should be to get that property full and nice, and actually, with some nice tenants that are paying rent, so that you can refinance into a long-term loan. Unless, like, your strategy is flip, but is it the best strategy sometimes, especially now? No, it's a dangerous kind of deal, unless ahead of time you're going to leave a lot of meat on the table for the next guy.
What I was really getting at, though, is that you mentioned that this is a race against the clock to do your rehab. So I was wondering if having tenants on the property slows that down. Is that not a concern?
Yeah, my policy at first is, and we do this everywhere we go, we'll send out a letter saying, hey, your rent is not going to go up. Because most of the time there are about 10, 20 units that are empty, and the rest of them are not. But let's say you have an instance where all of them are occupied and all of them have yearly leases. At that point, I would also get creative. I will probably start asking each person to, or the non-payments, I will actually try to process an eviction. If I can't, I will do some, what is it called, cash for keys, and try to make them leave at any cost necessary. Obviously, it's, again, like I said, it's a race against the clock. So if your strategy is to empty it out and increase the rents, you may want to get to know some of the tenants. Some of the tenants might not have a problem paying a higher rent as long as they're properly taken care of, which is the case we have seen in a lot of our complexes. Is, hey, we have needed a new stove and a new refrigerator forever. That's why we're not paying $700. Instead, we're paying $400. Well, okay, well, let me replace that and we'll hike up your rent. So make sure you're not just kind of one-minded and saying, hey, I'm going to get everybody out of here and goodbye. Sometimes it's best to keep the tenants that have been there a long time.
Are there any particular markets where this works better? And I don't mean like specific cities, but I mean like profile of the market where this works better. And also, are there markets where you wouldn't do this, or is it really solely about the differential between what you can buy it at and what you can sell it at, or what it's currently renting at and what it will be renting at later? What's the consideration? Is this like works anywhere, or you wouldn't try this in certain places?
I wouldn't try it in places. I mean, that's just me. You could try it anywhere, and obviously this works in California, but in a lot of blue states. The reason why I don't is because I'm from Texas. I kind of grew up knowing Texas law, so I like an easy eviction. I wouldn't do it in a place where it's hard to evict. And I know we have moratoriums now, and which make it harder, but we're still doing evictions. An eviction for non-payment is different from an eviction from end of contract. If your contract is ending and the owner wants you out, well, that's different than the non-payment eviction. So I personally would think twice about doing this in a place where there's a lot of tenant-friendly laws. There's, if you want to do it, I would probably start in a landlord-friendly state like Texas, Georgia, Florida. There's a few. That doesn't mean that you shouldn't. Obviously, this formula works well anywhere. The whole forced appreciation and being 100% owner of your own deals. It works anywhere. Just make sure you're looking at all variables.
What about population growth and things like that? Do you?
Oh, obviously. So population growth is something that we do keep in mind. I know that sometimes we like to refer to Neil Bawa's kind of training on what the population is doing, what the market is doing. So we will do that when we go into a new market like Florida. But I think most people know of their local places they can be, or their local statures and what the market is like where they are. Would I try living in Houston? Would I try right away if I was a beginner to invest in New York or Georgia? No, I probably wouldn't. I would probably stay close to where I am so I can at least monitor the situation when I'm first starting out. Now after I've picked up some experience and know-how, then I'm more comfortable with going somewhere else in another state. So starting out, definitely remain local.
Yeah, that was a question that I was going to ask next. Kind of the last question here from Hamad was, how easy is this to do in a different market? Like if you're in a market that doesn't have favorable demographics or favorable laws or what have you, that you want to do it someplace else, how feasible is it to do it someplace else that's at a distance?
Yeah, you can do it. Again, it's all about your team. You're probably going to have to fly there a few times. But I think definitely if there's deals that are identifiable and they make sense all around, and you've kind of checked every box, the next step would be obviously to get the right financing, the right team out there, and the right contractor, the right management to somebody that's sort of trustworthy, or at least that you can depend on to give you the right information. So definitely it's doable. Not saying, hey, stick to your own local market. It is easier, but it's not impossible to do if you're remotely.
Well, that's all the questions I have. Do you have any final thoughts to pass on to the audience before we?
No, obviously, it's easy to get wrapped up in the thinking of like, oh, hey, I've invested in a few units. I'm going to syndicate now. I want to start syndicating. I mean, that's great, but you're kind of changing the game. You're going from A to Z at that point, because you're fully confident that you know what you're doing. You have the experience being an active investor. Why not grow that market? Why not grow your market share as an active investor? And it's not just about, having 200, 500 units, 600 units. Most of the time when I go out to these kind of some conferences, the first question I get asked, how many units do you own? How many units do you own? Well, and people say 4,000, 5,000, 6,000. Great, but what percentage of that do you really own? Like 5, 10%? Or do you work maybe salary for a company that owns that many? I can confidently say that I own and know all 512 units that I own, and all 800 plus units that I have owned. So they have made a very comfortable life for myself and my family. And I can, kind of invest time in finding peace and other things rather than, man, what's the SEC going to think now? And do I need to cash call for this place? And I don't have a lot of the problems that obviously a lot of my syndicating partners or peers do.
Well, very, very attractive business model, I have to say. So once again, Boris, really appreciate you being on today. This was really fun and educational, and thanks again.
Oh, thank you, Jonathan. I appreciate it. And thank you. I'm looking forward to James's being a panelist.
Yep.
And information.
Cool. So share your screen if you would.
Okay.
Yeah. And I will bring up James for our final presentation.